Hi, it's 4 p.m. here at DBS Asia Central. I'm Taimur Beg, DBS Group Research's Chief Economist, welcoming you to our February Macro Insights Livestream. I'm here with my colleagues, Senior Economist, Senior Strategist for Rates, Eugene Leow, and Senior FX Strategist, Philip Wee. Hello, gentlemen. Our last presentation before the Lunar New Year holidays.
Yeah, looking forward to reunion dinner.
Absolutely. So Philip and Eugene, you will be talking about the FX and the rate stories after I do a little bit of the economic stuff. Right. So I'll see you in a few minutes. But for now, I will spend the next, say, 20 minutes or so going over the global macro backdrop. As you can see, the title of our presentation is about calm markets and geopolitical unrest, a bit of a contrasting theme. We will actually start with the geopolitics and then move on to the economic drivers that has led to the markets being rather calm despite all the geopolitical noise around. So let's get going with the presentation. But just remember, this is not just about us telling you what's going on. You should be telling us about what's at the top of your mind, which is why on the screen right now we have the QR code for Pigeonhole. And just scan the QR code and you will enter the Pigeonhole interface to submit your questions, which I will review and bring them up at the end of Philip's presentation, which will come after Eugene, of course. If you can't access the QR code for some reason, just go to your web browser, dbs.pigeonhole.at, and enter the passcode dbsmacrofeb, which is also on the screen right now. And if you haven't managed to follow either of them, don't worry. We'll do this several times going forward. This is the outline of today's presentation. I will talk a bit about geopolitics, the U.S. macro outlook, which even a couple of months ago was, soft landing or hard landing. I think the probability that is rising is neither of those, but rather no landing whatsoever. We'll take stock of the latest macro data and where things are going. And then we will do some exposition on China's rather challenging macro backdrop, where policy is going. And then we'll talk about the much awaited bottoming of electronic supply chain dynamic in Asia, particularly with respect to exports. I will then pass the baton to Eugene, who will talk about the rates picture, which has gotten a bit complicated in the recent couple of months because of the rather strong outcome out of the U.S. economy, even as inflation has sort of softened. And then Philip has a selected few key exchange rates that he wants to mull over during his section, and then we'll do the question and answer. Okay. So geopolitics. There is a lot going on around the world. Although headlines are all about the Middle East, the Ukraine-Russia matter has not faded at all. In fact, we're talking to you on this Thursday afternoon in Singapore, 8th of Feb. There is quite a bit of consternation in the U.S. because the bill to support the war efforts or defense efforts of Ukraine has more or less, died in the U.S. Congress and Senate because they're being tied to immigration issues and other things. So we have unresolved issues in Ukraine, Russia, and we have a rapidly deteriorating situation in the Middle East. What began as Hamas's attack on the southern part of Israel and mighty multi-month, almost 27,000 casualty response from Israel, now has morphed into tit-for-tat regional conflict, Houthis striking ships in the Red Sea. Things are happening to U.S. bases in Jordan and Syria and Iraq. And of course, Iran is the undertone in all of this. And even as we're speaking earlier today, the U.S. struck a sort of Iranian sympathizing military commander in Baghdad, Iraq. So the conflict has become rather multi-pronged. The risk is, of course, it expands even further. Lebanon is on a regular basis becoming a flashpoint between Hezbollah and the Israeli army. And then, of course, there are other things happening, particularly with respect to Syria. So the U.S. is involved in trying to respond forcefully to some of the challenges and provocations that are happening in the Red Sea, but at the same time giving the signal that it doesn't want to get into a big, wider war. And of course, it is trying very hard to bring the Israelis and the Hamas leadership to some sort of a truce, some sort of a ceasefire, but it's lots of ball up in the air. There's very little trust and goodwill between the antagonistic parties. And as for our sort of a market perspective, of course, the immediate implication is what happens to global shipping, what happens to global energy prices if this conflict festers or exacerbates in the coming weeks and months. Now, it's remarkable that despite that rather protracted and complex dynamic in place, we haven't seen the market respond in a knee-jerk, panicky manner so far. As you can see on this chart that I have on the screen, freight costs have gone up quite a bit. Insurance costs are going up. Shippers are concerned about taking their containers through the Red Sea. Some of them are taking the very long way around Africa to move their goods as opposed to going through the risky area lane of the Red Sea. And understandably, that has led to a spike in shipping costs. But this is nothing like what happened during the pandemic in 2020 or 2021. So yeah, it's a little higher than pre-pandemic levels, but nothing that the global shippers or the global producers and exporters cannot deal with. So I don't think the kind of spike that we've seen so far is a harbinger for major supply side disruption, inflation, anything of that nature. Further exacerbation, who knows? But so far as shipping is concerned, one needs to be worried. One needs to keep an eye on it, but one doesn't have to revise one's inflation perspective based on that. Second is the issue of oil. Again, given that there's so much oil that's sort of flowing through that part of the world, oil and gas, and the various parties involved are, of course, some of the largest oil producers and exporters in the world, you would think that both the spot and future energy price market would start showing a great deal of nervousness. To the contrary, it hasn't really done much. We're still talking about $75, $80 oil. The global market is pretty well supplied. More critically, demand is rather subdued. We will talk a little later about how strong demand is in the US, but that strong demand story sort of ends once you leave the US. The rest of the world, with a few exceptions here and there, like India or Vietnam, by and large, growth picture is pretty subdued. And China in particular is such a big drag on global demand with respect to energy that despite the concerns around the Middle East, oil remains very well behaved. So shipping or oil, two of the most obvious areas where one would expect to see a great deal of nervousness and speculation, risk premia, and not much has happened. So fingers crossed, hopefully we see some détente, some peacemaking efforts succeeding in the coming months, or else it's not just about the issue related to oil price or shipping price. Global peace would be at stake. Then the next issue is U.S. elections, which is a good 9 months away, but this is the year when it'll carry a lot of headline, probably, as it seems like, round 2 of Biden versus Trump. And depending on which side of the political spectrum one stands on, there is a great deal of speculation and nervousness about the U.S. election outcome. And as 2020 showed, that it's not just the U.S. election outcome, the process of actually putting a precedent in the White House itself has become a little more complicated in the U.S. than it had ever been in its long history. Of course, the U.S. elections have one immediate bearing, which is U.S. policy toward China. While it is not like the Biden administration has been friendly to China or has taken any major measure to ease tension between the U.S. and China, but still one can say that there is a greater degree of dialogue between the Chinese authorities and the Americans. There hasn't been any major exacerbation of China-U.S. relationship in the last 3 years, and it is unlikely that it would worsen anymore this year as long as Biden is in power. Even the balloon incident of 2023, or the fact that the U.S. really hasn't cut any tariffs, or the rather widely watched and speculated over Taiwan election, none of those developments have led to any exacerbation in China-U.S. relationship. China has a lot of domestic problems to deal with, and it definitely is not in the mood to ratchet up pressure vis-a-vis the U.S. in any respect. But if Donald Trump were to come to power, I think we should just take his word for it. He will add more rounds of tariff against China. He will make things more complicated against China, and that, of course, would have some degree of repercussion for the Chinese economy, for the global trade dynamic, and the whole de-risking from China and de-linking from China and so on. Those sort of words would become even more prevalent in corporate boardroom discussions. So as far as the U.S.-China election relationship is concerned, the 2024 elections would again be rather seismic. And in my particular vantage point, I think that once the U.S. elections are over, and if we indeed see second term of the Biden administration, there will be actually quite a bit of concerted effort to ease tension vis-a-vis China, whereas I think we can all safely predict where things would go if Trump were to come back to power. Now, I talked a little bit about Ukraine-Russia earlier in terms of broader conflict risks percolating around the world, but let's just be a little more specific. At the end of the day, there is a lot of grain still moving through Ukraine and Russia to the rest of the world, so global food security still hinges on the outcome of the Ukraine-Russia conflict, and there's, of course, Russia's role in supplying energy to China, India, and its allies, and how all that pan out. So right now, again, going into the U.S. elections, it seems like at the ground level, at the congressional level, at the Senate level, the appetite to support Ukraine from the U.S. side has waned quite a bit, and which is why the Biden administration is really struggling to shore up the funding that Ukraine badly needs. Again, just like the China-U.S. issue, I think we can all pretty safely predict that a Trump administration would be bad news for Ukraine. Trump has revealed his disdain for NATO participation or Ukraine's need for protection against Russia, and he, of course, has been traditionally quite sympathetic to the Russian leadership. So I think that, again, we don't need to think too hard. Both administration, the Trump administration from 16 to 20 and the Biden administration from 20 to 24, have acted exactly according the way they had said they would act before they got to office. It'll be far more constructive toward Russia as far as Trump is concerned, far more constructive towards Ukraine as far as Biden is concerned. So these things are problematic because as far as Europe is concerned, there's only a single stance on Ukraine, but they would have to calibrate their stance in terms of funding the war effort if the American White House outcome is to go one way or the other. And again, I think this is something that is certainly adding more complexity and uncertainty on the Ukraine-Russia conflict. So not a whole lot of positive things to talk about so far, but let's also keep in mind that on the Ukraine-Russia side, there is some element of exhaustion, that we're not seeing any major thrust across fronts by the Russians or the Ukrainians so far. And also on the Palestine-Israel issue, while Benjamin Netanyahu seems to be a pretty strong fork in the road, or rather thorn in the side of any peaceful negotiation outcome right now, but there is still a strong effort being pushed by the U.S. To get some sort of a ceasefire going there. So it may look bleak right now, but it is not that the parties are not talking, negotiations are not happening, they're still happening. So hopefully by the time we come back to the next live stream, we can come back with something more constructive for you. Now, the U.S. Leave geopolitics behind. Why are the U.S. markets in such euphoric state? Well, to start with, inflation is waning. If you go interview the U.S. manufacturers, which is what the ISM manufacturing survey does, on the price side, there hasn't been any trend toward major upside to prices. After many months of major decline in observed price pressure as far as the manufacturers are concerned. In fact, as far as the manufacturers are concerned, the peak in prices was way back in 2022. That all of 23, in fact, from the manufacturer's perspective, was characterized by waning price pressure. And now stepping into 24, we're seeing some flattening out, no further decline, but it is consistent with, I would say, 2.5% core PCE inflation. Given the way these two lines move, as you can see in the chart, the lead-lag relationship, I think we can safely say, just based on this relationship, more downside to core PCE is forthcoming. Excuse me. Then there is the U.S. job market, that while inflation is coming down, wage growth has not come down in a material manner. And as a result, we can say that real wages are going up. I'm going to show a chart on that momentarily. And also unemployment, incredibly comfortable, down to 3.7%. A lot of people who were sort of reluctant to come back to the labor force during the pandemic years, they're beginning to come back. And those who are looking for jobs, they still find multiple job offers when we look at quit rate, hiring stock data. Things are really, really good for wage earners, workers in the U.S. What's happening to the housing market? High interest rates and high mortgage rates had some temporary impact on housing prices, but things have turned around again. And 2023 ended with U.S. housing prices up about 6% on a year-on-year basis. In fact, what is remarkable about the red line on this chart is that it never went into negative territory. So housing prices, despite this historic rate hike cycle, never actually contracted. They flattened out. They're bouncing back again. And the fact that long-term rates have rallied and mortgage rates have eased a little bit, even before the Fed has cut, is only going to add further momentum to this market, no question about it. What about the U.S. consumer themselves? Yes, they are still out shopping in a big way. December retail sales number, real terms, nominal terms, including autos, excluding auto, month on month, year on year, annualized, any which way you cut it, blockbuster numbers. So U.S. consumers who were supposed to scale back on consumption in 2023 as high rates began to hurt, as COVID era checks expired, they seem to be still seeing things as pretty rosy. They are adding up on debt, which may be a harbinger for tougher times to come. But right now, credit availability, credit supply, cost of credit, nothing seems to be that high or that difficult for U.S. consumers to continue with their consumption. Consumption makes up 65% of U.S. GDP. And as long as that is rising, U.S. growth will continue to do pretty well. I said earlier that I was going to show a little bit of real wage story, and this is an important one. There are many ways of calculating real wage. There's Atlanta Wage Tracker. You can subtract whole overall inflation from that. We're trying to be a little more nuanced here. Here, what we're doing is annual average wage growth, the hourly wage growth, and we're taking the difference between that and CPI inflation. And that's getting us, more than 1% real wage for 2024. That's a big change from the high inflation-driven negative real wage growth in 21, 22, and even very flat outcome for 2023. So U.S. consumers, while maybe facing high cost of funding, are actually seeing their purchasing power get better this year, unlike, say, the last few years. So again, it tells you that consumption resilience just may persist. Putting it all together, how is the U.S. economy looking? In the fourth quarter, big beat over consensus expectation. For the year as a whole in 2023, U.S. grew by 2.5%. For the first quarter of 2024, no sign of slowdown whatsoever. In fact, Atlanta Fed nowcasting suggesting U.S. right now growing at a rate of 4% plus. So that headline that I have on the slide, no landing question mark, right? Where is the sign of soft landing? We really have to look hard to find some credit card delinquency data here, some commercial real estate market stress there to find things to worry about. Because overall, from a consumption, asset market perspective, from people's consumer confidence perspective, things are really, really good in the U.S. right now. So what if growth doesn't slow materially? Do we have to give up on rate cut outlook? Or is there still some argument to be made for some rate cuts in some point this year? So there are 4 bullet points on the screen right now. The first one is an important one. Our forecast of 1.5% GDP for 2024, just in 1 month into the year, already looking rather fragile. I think that there is huge amount of upside risk to that number. U.S. could very well gear up for another 2% growth here. Things can happen. Financial stability issues can get in the way. High real rates could start hurting, credit worthiness of consumers, and banks could come in trouble. There are things one can always, conjure that would start hurting growth. But at this moment, just looking at the consumption dynamic, it seems like that 1.5 is going to be beat by the time the year is over. Second is that if we're going to have 4% real growth, as we're seeing from the nowcast number for Q1, that is not commensurate with bond yields going below 4%. Eugene Leow will come a little later, and he'll talk about how he sort of sees the bond rally, but he also sees some degree of unsustainable dynamic embedded into it. One of the arguments there is this: you can't have such high real economic growth rate and expect extremely low real interest rate at the long end of the spectrum. And of course, things are interrelated. You can have very strong demand and no inflation. You could have some disinflation when there's strong demand, but it can't go on forever. So that's our third point, that if we're going to have another year of 2% plus growth, and in the first quarter we're going to have something like 4% growth, how on earth can that have no impact on the inflation dynamic? So if you have tight labor markets, strong growth, it's very hard to see inflation settling at 2%. And I think that's the issue that is going to bother the Fed going into its window of rate cut at some point this year. So we think that despite all this we just said in terms of tight demand and inflation may bottom out long before it sort of settles at 2%, if all those things are true, would the Fed then give up on cutting rates? The answer is no. We'll show you a chart on real rates in a second, but by and large, there is still room to cut rates given that, Fed funds rate is all the way at 5.5 without necessarily, affecting the inflation dynamic. One could argue that inflation may be low because of goods price inflation, but there could be demand pull, disinflation dynamic if real rates are kept high for a very long time. Would you want to risk it, or would you want to stop conditions from becoming overly tight? At the end of the day, the Fed's job is to maximize employment, prolong the cycle, and would it cost them a lot if they were to cut a little bit at some point this year? So that's what we have in mind with respect to the Fed rate cut scenario, even though right now, I think the fair question to ask is who on earth needs a lower rate cut in the US, given how strong things are? All right, this is the issue, that even in a low lending scenario, we right now are on a trajectory of progressively higher real interest rates. So that are short-term real interest rates toward 3% and long-term interest rates at over 1% or so. Now we've had a huge rally at the long end of the market. I apologize for the typo. The second chart here is not U.S. short-term real interest rates, but rather U.S. long-term real interest rates. The left one is short-term. But as you can see that the black line, the solid part of the right-hand side line, has sort of flattened out. That's the reflection of the big rally we have seen at the long end of the yield curve in the last few months. We think that if inflation keeps on falling, even then the real rate will go up, and U.S. short-term real rate, of course, are substantially higher than anything that we have seen in recent cycles. So there is room to stabilize short-term and long-term real interest rates, or bring them down a tad to ease up on the monetary conditions. That we think could be a useful insurance-type rate cut from the Fed. So I think, again, Eugene will come and talk about this, that not all rate cuts are the same. We're not talking about a recession scenario for the second half of the year around which the Fed would have to cut. We're talking about a situation where growth may have topped out, inflation looking like in the Fed's comfort zone, and around that, is there room to cut rates? That's the sort of scenario we're looking at. All right. Now, again, everything is interconnected. If we're going to have strong growth, if we're going to have some rate cuts despite the strong growth, what about the asset markets? Well, asset markets, lots of froth already. This is the long-term price-earnings ratio of S&P 500, has gone over 30 in the last few weeks because of sustained rally. It's still not as loftily valued as the 21-22 part when we had a big correction in the tech stock. But if you compare to how things were before the global financial crisis, market is very, very expensive at a time when risk-free asset returns are high. In my view, this doesn't make a lot of sense, unless, of course, you start taking into account some of the secular tech AI narrative, which is funneling a huge amount of capital and interest toward the large stocks in the U.S. stock market. But it's not just the stock market. What's happening in the credit space? Historically low compression in credit spreads, both at the investment grade and high yield levels. These are unusual developments. The kind of rate hikes that we have seen in this cycle, it should not lead to these sort of a benign situation, but it has so far. Markets are very calm. They're in frothy territory, and we are waiting for rate cuts. So it's hard to conjure a scenario under which the markets are disappointed, unless it is going to be real fundamental type developments like earnings beat disappearing in the coming quarters because high cost of funding or some other global lackluster demand starts eating into earnings of large companies. But we're really, really not there yet. Okay, let me quickly move on to a couple more things. One is China, where we have started the new year, or rather the Western New Year. We're heading into the Chinese New Year with a lot of efforts, a lot of noise, a lot of announcements from the Chinese authorities, but it has not yet amounted to confidence returning to Chinese investors, or rather investors in the Chinese markets, both Chinese and foreign. We are seeing pressure on the RMB. We are seeing interest rates progressively come down. And these sort of outcomes sooner or later brings back some value-seeking investors who might find the currency too cheap, or who might find the bonds attractively priced, or more room for rally because more rate cuts and accommodation is coming. We should be seeing people borrowing in this low rates and putting them into the extremely cheap Chinese stock market. But guess what? Nothing so far. Maybe this is like the darkest before dawn type scenario, that these sort of rate cuts, these sort of weakness in currency would pave the way for China to bottom out in a convincing manner this year. But boy, it would take a very brave investor to go for that thesis, because that thesis was there last year, and investors would have lost a lot of money going long China last year. So we do see elements in place for a bottoming out of the Chinese economy and markets. We do think many more easing measures are in the pipeline, but we are also a bit cautious, because we could have made some of these arguments about a year ago and we would have gotten it wrong. Finally, on Asia, the electronic cycle is the key story right now. We could have talked about various elections and so on, but I think we will save it for next month's live stream. We have been talking about this issue for the last few months, that when you look at order books, advance orders, and overall demand metrics from global manufacturers and sources of demand, Asia should be seeing their rather poor electronic cycle of the past couple of years bottom out, and some of the countries in Asia should see some good exports numbers. The two charts that I have on the screen cover the January data already, and that shows that for Korea, which is on the high end of the electronic spectrum, and Vietnam, which is on the mid end of the electronic spectrum, big pickup in exports growth over the last couple of months, and you can see that also reflected in their manufacturing surveys. So we would like to think that this will broaden from January to February to March, and Q1 overall, Asia will get some support on the electronic side. And I want to hasten this point, it is not just about AI and EV. There seems to be a broad-based cleaning up of inventories and a secular demand cycle coming up. And let's hope that Asia rides that and get benefits through the course of 2024. Okay, so I'm gonna stop right there, and I'll bring back Eugene to the floor. Eugene, so why don't you go over the rates picture for us?
Great, thanks very much, Simon.
Thank you.
So before I go into my presentation, if there are any questions, please fill in the pigeonhole. And moving on. So I think we are at the point of the cycle where it's worth taking stock, right? It's been a big change, and most of the central banks around the world, they have paused. And if you zoom down to the G3, you can see that the Fed has taken the policy rates all the way to 5.5%. And for the ECB, it's not that far behind. The ECB went all the way to 4%. But Japan clearly stands out, because Japan did not move the balance rate during this cycle. To be fair, they did tweak the yield curve control, but it was not so much on the short-term rates. So there's a bit of divergence here with the G3 that's at play here. That's one theme. And the next thing to think about is, as tightening slows and stops, which is where we are now, financial conditions have eased significantly. You can probably see this in the performance of US assets over the past few months as well. So the divergence extends not just in terms of policy making. You can see the divergence in the GDP growth numbers as well. And you see that Japan is holding up quite well. Now the US is doing remarkably well, looking at the GDP growth numbers over the past few quarters. And if you look at the now past figures, we might even see an acceleration in 1Q, right? So this comes despite all the rate hikes that have taken place over the past 2 years. Now, on the other end of the spectrum within the G3, the Eurozone is practically at stall speed for the past 2 quarters. So, again, divergence over there. Now, what about CPI? Now, the trajectories there are roughly the same, just rising, and then falling over the past few quarters. But the key point there is for Japan, the decline in year-on-year CPI is a lot more muted compared to the other two, right? So again, divergences in terms of growth as well as inflation. And to drill down deeper into inflation, because this was such a big theme over the last 2 years, and I think one of the ways to look at it would be to see how inflation expectations have evolved, and that's where we have the break-evens, the chart on the left. So yes, broadly, these fears have subsided, but where they are settling at is significantly higher than where they were pre-pandemic, and we think that is justified. Right? So if you want to go another layer deeper, that will be the chart on the right. So we split the break-evens across 6 different countries, and we compare where they are now to 9 months ago. So what are the standouts, right? So again, we're looking for divergences. If you look at Japan, inflation worries are higher now compared to 9 months ago. Now, compared to Germany, right, where inflation worries are a lot lower now compared to 9 months ago. So again, there are differentiations, even though we see the broad trend that inflation is no longer as acute of a problem now. So what about real rates, right? So real rates are nominal rates less implied inflation, right? So real rates have fallen, right, because the bulk of the tightening, the aggressive hawkish central banks era is over. But real rates also embed some of the growth expectations. Now, if growth is going to be holding up relatively okay for some economies, such as the US, then there's not much room for real rates to fall, right? And the other point that we want to note that on inflation is that I think a premium has got to be embedded within inflation expectations. So in this era that we are in, shocks have become more common. So on the right-hand side, we're talking about supply chain worries. Yeah, the cost and the index, it is going up, right? So are we going to have more conflicts? Are we going to have more disruptions? So all these things require a premium. So the premium shows up in break-evens, and in terms of real rates, it shouldn't be too low if growth is holding up okay. Now, Timer mentioned about the Fed can cut even if growth holds up well. And I think the key reasoning here, we have to keep in mind that the Fed has a dual mandate. So one would be on full employment, and the other would be on stable prices around 2%. So the gray line is our own model of Taylor rule of what the policy setting should be. And the red line is the Fed funds rate. And we know that in the early part when inflation shot up, the Fed was trying desperately to catch up. It was not until recently, as inflation falls, that the gray line and the red lines converge. And this convergence means that policy settings are appropriate right now. Now, if we go deeper into this year, then as inflation in the US falls closer to 3 and then below, then it makes sense for some of the calibrated cuts to kick in. So our forecast of 100 basis points of cuts this year, starting in the middle of the year, which we have kept in place since July last year, is still in play. So the emphasis on the type of cut cycle is very important. So the chart on the left shows you a sampling of the cut cycles that the Fed has undertaken over the past few decades. Now, people remember the deep cuts, right? And these are typically associated with crisis, like GFC.com, right? So the Fed can cut 500 basis points in the whole cycle and in a very, very short amount of time. But are we in a crisis? Are there other types of Fed cycles? So I think the 1990s is important to consider because while Asia had a rough 97, 98, the US by and large was holding up very well through the period. So the Fed cut a little bit, held rates steady, and even re-hiked before holding rates steady for a really, really long time. So I think the point here is to identify what kind of environment we are in, and that would determine the type of easing cycle. The chart on the right shows you that we have been at peak rates for 6-7 months, and you compare it to the other cycles, it's starting to be longer than average, as the Fed is still cautious about inflation getting back to target. If we get towards mid-year, that would be one of the longer periods where the Fed kept rates that high. Now, within the DM space, I talked quite a bit about divergences. But moving out into Asia as well, I thought a good way to compare would be real rates, real policy rates over the past few months. And I put the maximum, the spot, and the minimum. So you took one glance around. For many of the economies, real rates are high, which makes sense because policy rates generally have been held steady, whereas inflation has come off. So there's natural tightening going on. Now, what stands out? Now, on the high real rate spectrum, we have China and India, right? So in theory, this provides them with more leeway to cut rates if the central banks wish to do so, if the environment becomes more friendly. Now, Japan stands out where real rates are incredibly low. Now, that again is a policy decision, and which also argues that there is leeway for Japan to normalize interest rates, get out of negative interest rates policy in the coming months if they so choose to. So if you look across the performance across the 10-year yields since the start of the year, there's been an adjustment, right? Because in the last quarter of 23, we have a lot of optimism about Fed pivoting and then bonds rallying hard. But it might be a bit overdone. And if you look across G10, EMs, Asia, we have generally 10-year yields rising from very, very depressed levels towards the end of last year. Now, within Asia, you should note that the two best performers where 10-year yields fell, that would be India and China. And that's again correspond to the real rates argument that we have, that for those two economies, real rates are high and there is some leeway to provide some easing if needed. So this will be my last slide. I'd like to say that there are three different speeds in the G3 and the DM, right, in general. So there are divergences in terms of policy making. There are divergences in terms of how the economy is doing, and divergences how inflation is doing, right? But by and large, inflation is much less of a worry now, and should pave the way for easing for many central banks later this year. However, the extent of easing, we have to differentiate. And between crisis cuts and calibrated cuts, which we are in favor of, the magnitude can be very different. We could look at real policy rates across the economies that we track. They're high in China and India and low in Japan. So that's another area of divergence. And for us, we remain in the soft landing camp, but it looks like the risks are actually towards a little bit of reacceleration, especially looking at the US data over the past few months. So that's all I have. Well, Philip, we will talk through the FX picture.
Thank you, Eugene. Okay, I'm sure you found the two sessions quite interesting. I'm sure you have many questions. So if you have them, please post them in the pigeonhole, scan the QR code, and the password is on the screen. Okay, so I'm going to be telling you about FX. I think many people have been pretty confused, over the past year or so. I don't blame them. So I thought maybe it would be good, to have a quick review. Okay, let's start out with this dollar index from the Fed hike in 2022. So you can see that dollar, surged very strongly when the Fed was pushing for aggressive jumbo hikes of 75 basis points. But the moment inflation peaked and the Fed, was saying that, oh, I don't need, to be that aggressive anymore. I can afford to scale back the hikes, and the dollar corrected, sharply down. But of course, the markets will get very carried away with the momentum, thinking that they'll be moving to rate cuts. And that's where, the Fed has been pushing up. And that's the reason why the dollar index has been in this range. So you always find, the struggle between the markets always pushing for rate cuts, and the Fed always pushing back with higher for longer. Then meanwhile, monetary policy guidance of all the central banks, they were converging. Last year was about all coming to 25 basis point hike, then moving to a pause, and now, of course, the rate cut guidance. So again, we saw the sort of volatility that we saw in the late 2022. And so in the second half of this year, or rather in the third quarter, when U.S. exceptionalism came in, U.S. GDP growth was 4.9%, way above everyone's expectations. Markets got crazy. They were pricing for 6%, for Fed funds rates to reach 6%. But of course, Fed continued to pause. And in the last 2 months of last year, the markets have switched and they started going big in terms of the rate cut bets. And that's where the dollar has been pulling up, this month or since the start of the year, from the Fed pushing back, saying that I'm not ready to declare victory on inflation, but everything seems to be in the right place, in a good place, for monetary policy not to be that restrictive. So that is the term, I guess, normalization that's feeding through, that central banks, wants market to know that when they cut, it's not because the economies are weak. Okay, for our outlook, we have placed a lot of emphasis on two key events, especially for dollar Asia. One is that we see the Bank of Japan ending NIRP in the second quarter, followed by the Fed cutting rates by 100 basis points in the second half. So together, we believe that second half of the year, when we do get, let's say, a cyclical recovery, especially in electronics, and also could have quite a nice setup, for the dollar to come down in the region. Okay. But meanwhile, let's deal with this no landing. So this is sort of a quick snapshot, a dashboard that I have to show you roughly where we are. So I think markets at this point in time, you have many interest rate outlook. So you have the futures, you have the consensus, and of course, you have the most reliable forecast, the DBS forecast. So as we can see in terms of the futures, it has sort of tapered off after all the recent strong numbers. Previously, markets were looking for 6 to 7 sort of cuts this year, but they sort of tapered down to, let's say, about 5, maybe, but I think the Fed has been pushing back and saying that, please pay attention to a summary of economic projections where we indicated 3 cuts this year. So I think we're still in the process of the markets adjusting, and therefore in the short term, the dollar may still have some upside. Okay, but that said, that doesn't mean that the Fed is done, that the Fed will not cut. In fact, if you look at the center middle chart, that is the New York Fed underlying inflation gauge. So I like this chart a lot because it signals, when it hits a level, let's say about 2.5%, so in the last 2 cycles, that's when the Fed is ready to cut, and we are below 3% for this indicator. But recently, non-farm payrolls are surprised. GDP, as Timer mentioned, Atlanta Fed is looking at a strong 4%. We've seen a big pickup in terms of the consumer confidence index, especially in present situation. A lot to do with the fact that now, long rates are down, mortgage rates are down, stock markets are at record high. So naturally, Fed, feels a bit uncomfortable about the conditions being, a bit looser than what they like to see. So overall, I would say that let's, ride through this. So without that, this could be sustained for the rest of the year. Okay, so let's start off with a few currencies. I'd like to start off with the Japanese yen. So going into the next quarter, the biggest question everyone will have is, when is the BOJ going to end the negative interest rate policy? Well, I have here the Reuters survey. The last 2 months, you can see that the expectations have been increasing. Now, 20 of the respondents, getting firmer that April is going to be the month for the BOJ to move. And why is that? Okay, so the BOJ has been quite clear that wage growth is going to be important, and the Shunto wage negotiations, which have already started, are expected to end by early April. So according to the last table below, I think everyone just wants to see the wage increase for this year to be larger than last year's 30-year high of 3.6%. So Rango is pushing for more than 5%, UA Zensen about 6%, and even the economists is just slightly above, with 3.85%. So when I think this comes in, and coupled with the fact that by second quarter, we may see U.S. numbers start to soften, and Fed paving the ground, let's say, for the hike that we expect to take place from the third quarter, then dollar yen may start to come off from the top of its channel. Okay, let's move on to the Chinese yuan. Well, like the dollar yen, dollar China is high above the recent, the past 2 years highs. So a bit of it is homegrown. China has been having a lot of challenges convincing investors, that the stock market is fine, the economy is actually doing fine, but it's still facing a lot of challenges in the market. But what China is really hoping for, if you look at PBOC Governor Pan's comments, is that the Fed's pivot towards cuts towards later of the year. This should be good for allowing China, the policy space, both monetary and fiscal policy, to support, to address the growth concerns of investors. And also, I think looking at most of the consensus, I'm sure PBOC also expects, when the Fed cut rates, that the drivers of the dollar strength will also weaken. So PBOC market expectations still for them to cut rates, but I think we are looking for it to come at the last quarter of the year. They have opted instead to cut the reserve requirement ratio. But in any case, our forecast for US and China, I think also states very clearly that you see US growth coming off eventually, and the gap widening with China's, even though China's is lower. Okay, but we also do not have a forecast for deflation for this year, despite the fact that we just saw a negative number. So all in all, when all these factors come in, and when we see dollar yen coming off, leading dollar Asia down, we do not think that dollar China will be excluded. Okay, that's an interesting observation, and that is that markets and us, we have put the 6.80 as the target for the end of 2025. And I believe that reason for that is that that's where dollar China should be if it follows, if it tracks, let's say, the DXY, correlation. Okay, coming closer to home, okay, this is a Sing dollar. The good news is that I'm no longer worrying about dollar Sing moving above 140, even though last year I think we were correct about it hitting 137. So we are less concerned about global recession, some kind of global financial crisis. So I think our scenario is for soft landing or Goldilocks eventually, and this should be positive for dollar Asia, especially for dollar Sing, meaning positive the Sing. So, but because of, let's say, the legacy of dollar Sing still holding this 131, 146 range since the currency war in 2015, at this point we're reluctant to put the numbers below this 131 or even 130. Okay, so but Singapore is a price taker, and we do expect the Sing dollar policy to move towards a less steep slope. Okay, it's very important to understand a less steep slope. So this is like the normalization that I mentioned earlier, in the G7, where they still like to keep monetary policy restrictive, but it's just that inflation is no longer that big of an issue. If you look at the MAS forecast for both CPI and core inflation this year to average about 1.5 to 2.5% after stripping out the impact of the GST. So So we do see our policy aligning with that of the global setup. And of course, like last year, Singapore economy underperformed. This year, it'll be a switch of places looking at the numbers. So we will be above 2, with the US below 2. And our inflation, that's a headline with the GST impact. But overall, less steep senior and less pressure. But at the same time, Sing dollar is very strong. No need for it for dollar Sing to drop below 131 just yet. Okay, so let's talk about the senior. Why we think the MES can afford to be patient like the Fed. Okay, on the left-hand side, this is our own in-house senior. So you have seen all the steepening. We had recentering up of about 4%, and the slope being increased from 0% to 2.5%. And how does this work? On the right-hand side, you can see the year-on-year changes in the senior, and see how it's been moving together with the CPI inflation up and also back down. And right now, because all the recentering, which is a one-off, and it's already been 1 year, more than a year since the last policy move. So the senior is only, the year-on-year appreciation is only reflecting the slope, which is currently hovering between the 2 and the 2.5% sort of range. So we think that there is scope for the slope, to move down from 2.5% to 2% when the MES is ready to join in the normalization of the policy. Okay, how does this play out? Well, the good news is that the seniors sort of, the year-on-year cooling off in terms of the appreciation. This has already led to some of the cross exchange rates stabilizing. So I have all the ranges here for the various crosses. In direct quote for Aussie, Sterling, and Euro, and indirect, let's say, for the other Asian currencies. So you can see that many of them have already started after October 2022. And, so the ranges are pretty tight. In fact, some are crazy tight, like the Sing Peso 41, 42 range, so like the one with Indian rupee, and even the one with renminbi. So when I think the loosening comes, let's say when the dollar weakens, the cross rate that I'll be very interested in, the Sing yen, the Sing ringgit, so this is when the weaker dollar starts, I think will sort of pivot, help to stabilize this currency pairs, with the weakest Asian exchange rate. Okay, so of course we can't leave without talking about the US presidential elections, especially now that everyone is keep asking what if Donald Trump comes back. So what we have done here is sort of show you how the DXY has performed in all the elections starting from 1972. Why starting from 1972? Because Bretton exchange rates only became freely floating after the end of Bretton Woods in 1971. So generally, at first glance, in the early, let's say if you look at the 70s and 80s, you would think that it is always a strong dollar year. Primarily, I think most presidents like to show that they've done a good job on the economy and like to reflect, the strength of the U.S. But in the last couple of elections, we noted that it's been pretty volatile. So the DXY, can start out the year strong, like in 2016, but it could end up, like in 2016 weak, but it could end up stronger when Trump won. So, but in 2020, it started out strong, but ended up weak. But that's because we were entering into the COVID recession. So far we have dollar has been up this year, but it's a lot to do, as I mentioned earlier, the adjustment, from the market being too optimistic about rate cuts in the US and in the G7. Okay, so if Trump comes in, a couple of things that people talk about is he has criticized the Fed for paving rate cuts to help Biden. So they think that this may be dollar positive with, if we get more fiscal spending and higher interest rates. But at the same time, there's also this question of challenging, the Fed's independence status. So, and this is considered dollar negative. So it's not that clear cut. On the other hand, for China, of course, the bigger question is, if Trump comes in, we all remember that there was a lot of, stress from the higher tariffs that he has imposed, and he has threatened to do even more when he comes in. Okay, so then there is the other thing is that what if Biden gets reelected? Well, that is, we got China de-risking. So either or, it is quite a challenging situation, I think, for China. But I think under President Biden, there's this view that at least there will be more dialogue between the world's two largest economies. So, okay, that's all I think I have. So I'm going to just leave you with the forecast. At this point, I think the first quarter forecast, is facing challenges for the strength of the U.S. The recent upside surprise in the numbers, but throughout the rest of the year, I want to highlight that the forecast for weaker dollar rests a lot with the soft landing scenario. But of course, we have challenges of China slowdown, and Europe is weak, and what if the Fed makes a 180-degree turn and decided that that he still needs to hike and that he's not going to cut anymore. So many questions, but at this point, our base case is still for a soft landing, rate cuts, and before that, the BOJ ending up, and therefore it's still for a weaker dollar this year. Yeah, that's all. Thank you.
Thank you very much, Philip. Let's take some questions. Let's go to the Pigeonhole screen. I have highlighted the first question. I guess Eugene and I will take this one. The first question is, let me just read it to you, Eugene. Will the Fed delay rate cuts if growth proves to be strong around 2%? I suppose the short answer is already being priced in by the market.
Yes.
I think 6 weeks ago, the market was expecting 100% chance that the Fed will cut in March. And now, both with strong growth numbers and strong confidence numbers, the market has priced it out. Of course, the Fed communication has helped. And now, less than 20% chance of a March cut. Yes. And the probability is now shifting toward May. Is that where the market pricing is?
Yes, that's right. Yeah, I think we answered the question in the presentation just now. I think we have to understand that the Fed manages via a dual mandate. And how restrictive policy settings are is measured by the real rate. And if inflation keeps coming off, the default is the Fed is continuing to tighten even as inflation is less of a problem, right? So the way I see it is the reason why we have the Fed at 5.5% is not because of strong labor markets. It's because inflation got to 9%. That was why we have such an aggressive hike cycle. But now that inflation is closer to 3%, then does it make sense to keep interest rates at 5.5%? Would that be a little bit too high?
Right. Then we're basically talking about, say, a steady state 2% inflation means 3.5% short-term real rates, and maybe 2.5% long-term real rates if there's no further rally in the 10-year market. So I think that's the critical issue, that you can have a strong growth rate scenario, but if it coincides with the Goldilocks of still softening inflation, then there's definitely room to cut rates. Unless, of course, we see massive froth and run up in the equity markets, which causes financial conditions to weaken and makes the Fed nervous. All right, we don't have that much time left, so let's take just at least a couple of more questions before we go. Philip, right before you were ending your presentation, you were saying something about challenges to our baseline scenario. So here is one challenge. What happens to the US dollar if the Fed does not cut rates at all this year?
Well, at this point, I would say that there's a lot of interest rate cuts being priced in the futures market. So we will probably need to work that off.
So this would be shocking for the market.
Yeah, so that should be, I think markets will have to make the adjustment, and this should be dollar supportive for now. But once the adjustments are over, and I do think the Fed watches the rates very closely. So when it comes to a level that they think that financial conditions are tight, then they will sort of tone down.
Right.
So that's why we are still in this range.
Right. Actually, I probably should have put this question on even before this question, because that's the question, which is, okay, we just told you what would happen to the US dollar if there's no cut, but in which scenario would there be no cuts at all?
It is possible, right? So the question here, again, if you just go back to the Taylor rule framework, right, is that inflation, if you look at PCE, annualized is running about 2%. But if supply chain shocks kick in, or if the labor market strength that we see persists, and what if China bottoms out and the electronic cycle turns, right? So are we going to see a re-acceleration in the global economy, or are we going to see a slowdown, right? So then there's also this issue of elections, right? Would Trump represent upside risk?
See, Eugene, right now, I probably don't assign more than 20% probability to that scenario, but 20% is not 0%. It's a 1 in 5 scenario. We have stepped into 2024 with already one of our core assumptions getting challenged vigorously, which is the US will slow this year. In fact, the US economy has accelerated this year. Now, if we build on top of that the plethora of easing measures that the Chinese authorities have taken so far, which haven't yielded any result, but that doesn't mean they won't at all, then in the second quarter of this year, this about 20% scenario, which is growth keeps on surprising on the upside, may well then start making them nervous, very nervous, because then our core assumptions of a soft landing, dollar will land, rate cuts, everything will be challenged. And boy, oh boy, you need to fasten your seatbelts and gird yourself for that, because there'll be a lot of volatility, particularly on the dollar space, maybe also in the rate space. So we're running out of time. We have one little thing to do before we finish our call. Philip? Eugene? We are doing this just a few days before the Lunar New Year. So we'd like to wish everybody a Happy New Year.
Happy New Year.
Gongxi. And take care, everybody. Have a great holiday weekend to those who are celebrating in the countries that you're fortunate to be in. We will certainly be celebrating, and we'll see you for the March live stream. Until then, everybody, stay safe, stay healthy.
哗啦。
恭喜恭喜。